Good afternoon, everyone. My name is Jeff Stern, and I want to welcome everyone to this month's edition of Keeping It Simple, titled Variable or Variant Weather. I'm joined today by Mike Green and Harley Bassman of Simplify, and Tian Yang, Chief Executive Officer and Head of Research at Variant Perception. Variant Perception is a macroeconomic research group that caters to hedge funds, banks, and family offices. Tian's work focuses on using proprietary leading indicators to generate actionable investment ideas. Prior to joining Variant Perception, Tian worked as an equity derivatives trader at Bank of America Merrill Lynch, where he was responsible for building out the Delta One global index business. Now, before we go ahead and get started, one note for the audience: please go ahead and submit your questions down at the bottom under the Q&A feature. And also a friendly reminder that everything discussed on this call is for informational and educational purposes only and should not be considered investment advice. Now that our lawyers have been satisfied, I'm going to go ahead and I'm going to turn it over to Mike to go ahead and get into today's conversation.
Thank you very much, Jeff. Just as a quick point of clarification, lawyers are never satisfied, so we'll continue in the best possible framework. Tian, welcome very much. We're thrilled to have you here. I've known Variant Perception for a number of years. I knew Jonathan quite well. Can you give us just a little bit more background on yourself and Variant Perception, and what led you to join Variant Perception, and kind of how you guys see yourself as differentiated within the space?
Yeah, absolutely. Well, firstly, like I said, I've been aware of your and Harley's work for a long time as well, so always been a big fan. And, maybe I don't reply always on social media, but definitely lurking and following. So I joined Variant in 2014. So as you mentioned, I was actually hired by Jonathan, originally as an analyst. And our philosophy on the market is this idea of, man plus machine can be man or machine alone. So we spend a lot of our time building various models of the economy and of asset markets, and really trying to think from first principles to understand how the real world basically works. And then if we truly understand how it works, then taking that and trying to turn it into like some kind of code so that's repeatable going forward. So in a nutshell, that's kind of the kind of key focus.
Got it. And now Jonathan and other members of Variant Perception have gone on to do other things. Jonathan is now currently managing money for institutional investors. He also wrote a fantastic book called The Myth of Capitalism. Did you participate in that process at all?
So I participate a little bit. Myth of Capitalism is mostly him. I think he gets most of the credit. I just do some of the grunt work.
Okay, excellent. And that's kind of how Harley and I operate. I grunt and he does work. Now, Harley, one quick observation from the audience to start everything off. Would you mind changing shirts to be seasonally appropriate? Is that possible?
Right now,
apparently pastels are really a post Memorial Day thing, pre-Labor Day.
You can wear white in California after Labor Day.
Oh, okay. All right, good to know. So now we've located that Harley is actually based out of California right now. All right. So listen, I think one of the most interesting things is happening here. I noticed Harley was blowing his nose before going in. I've been blowing my nose. Tian, are you sick as well?
A little bit.
Yeah, this is incredible. This has been the worst cold season I think I've ever seen. But the one thing that I would say has not caught cold, or at least people don't seem to think it is the U.S. economy. The consumer remains hot. As Harley pointed out in the preliminary, he got the inflation that he requested. So America, you can blame Harley. I personally was disappointed by those inflation numbers. I'd like to see them lower. Harley, what do you think is going on?
God. Team transitory. Eventually, it will come. It will work. Really, from the macro idea here is that the boomers made all the money, and these various studies that people have shown, you've shown a lot, of as people age and they retire, they spend less. I think that's probably true for the Depression generation, but for us, we have all the money, man, and we're going to retire and we're going to spend it, and we're going to give it to our kids, and they're going to spend it. I think I saw a number that 1/3 of all home sales earlier last year was that we're all cash, and
Yep.
they're getting the cash from somewhere. And I think this massive amount of money is going to be passed along or spent. And now that they're not working, they can spend even more. They don't have to go jobs. And this combines with the idea of we're reducing the boomers, taking up productive people out of society, it's supply, and we're bringing millennials who are forming households and they're spending to buy baby carriages and cars. And so you have more demand, less supply, and thus you have the inflation. Maybe I'm wrong, but it's a darn good story.
No, I think it is a darn good story. I think it's wrong. I agree with you, but it's also helpful to know, by the way, for our audience, that Harley has all the money. So if you're looking for a cash loan to buy real estate, he is the guy to turn to, apparently. With that said, like, I think the interesting dynamic is the question of, are you consuming more than you were previously, which is what's required for that increase in demand. And most of the evidence would suggest that actually baby boomers are now consuming less than they were previously, with one notable exception. Unfortunately, as spouses die and you become a widow or a widower, you are imputed to be consuming more housing. So it's going to be very interesting. I mean, to me, I don't know, Tian, if you want to toss in here, but this narrative of aging populations being very inflationary, I agree, by the way, that they're very supportive for wage rates, but I'm not at all sure that they are supportive for the idea of a growth in aggregate demand. That feels like a different factor. Tian, do you have a thought there?
Yeah, so one of the concepts we use to think about demographics is kind of analogous to kind of cycles of capital. So in a way, a little bit linked to your points, you can think of young and very old people as consumers, right? And then the middle kind of the population as kind of savers, right? That's kind of a traditional model. Now, when you do that globally, one of the things people miss is you got to wealth adjust it. Because obviously there might be a lot of young people in Africa and so forth, but a little bit on Harley's point again, a lot of the older rich people in wealthier countries. So when you kind of wealth weight the kind of demographics, you actually find a really keen kind of relationship between that and the 10-year, right, over a very long time period. And it kind of makes sense intuitively because obviously it's about how do you clear the global pool of savings, right? In the long term, presumably 10-year yield should really be clearing kind of the market for savings, right? All the kind of middle-aged rich people have savings and then the people consuming, and you just kind of adjust it. So on that model, we actually have a pretty strong trend for the next 10 years of a higher equilibrium 10-year yield, right? And that's a very strong relationship. It goes back all the way to the 60s. So from 60 to 80, you catch it up. 80 to 2010, you catch it down, and 2010 is the bottom. And so there's like a very big structural kind of flow concept that is a little bit how we think about the kind of shift in populations.
And so so that actually opens this up. Great. Let's pause for 1 second. We're going to show the poll that we put out on Twitter earlier today, which hits on this idea of inflation. And I think this is actually pretty consensus. This matches up pretty well with what we're seeing from the Michigan reports, et cetera. If we can pull up those poll results, or actually, I guess the poll question asking, what do we think inflation looks like? There we go. So end of year CPI core inflation for 2024. This would be the equivalent print in December. That would be the December print for January of 2025. Believe it or not, we're all planning on still being around at that point. Harley, you're still going to be with us by January 2025, I hope, right?
Touch and go.
Touch and go. Okay. So we're not, hosts and panelists are not allowed to vote, but I'd love to hear what the audience is thinking here. This is going to be interesting to compare this to the results that we pulled off of Twitter earlier today. Interesting. Okay, so our audience is less inflation sensitive. Let me see if I can pull up the Twitter numbers as well. I will share my screen just very quickly here. So just in comparison, on Twitter, the expectations are clearly for 3% plus inflation. The audience for this is more in the 2 to 3% range. That sounds like we have people that are more either economically more bearish or more convinced that the inflation narrative is going to retreat a little bit more this year. Ken, where do you guys think you're going to see, given your kind of, the strong alignment that you have with the 10-year, which I just want to make very clear for people is actually a slightly different statement, right? So, and I do actually think there's a really important point that Tian is bringing up. It's one that Harley emphasizes a lot as well, which is this underlying idea that the growth of the economy is relatively closely correlated with the 10-year rate, right? So what you're effectively saying is something very similar to that the cost of funds should be similar to something like the opportunity set that's created by wealth, the existence of wealth and consumption opportunities going forward. That's really the relationship that I think you'd be hitting on, right?
Yeah, over like a long period, 10 years, right? And obviously
Over a long period of
always
time. Okay.
1 year out. So I think that puts us more into kind of the business cycle cyclical bucket. So obviously we'll have an anchor, but clearly the business cycle metrics are going to matter a lot more for kind of that number. And I would say our leading indicators for inflation actually worked really well last year, up and down. Obviously, growth lead indicators across the board failed for the US, but inflation did pretty well. And that's actually starting to bottom. So it foresaw the kind of disinflation that we're starting to see from Q4 to now. It will probably go a little bit more, but we think it's more going to be kind of a bottoming out process. So 2 to 3 feels about right. There's not that much to give you worry cyclically right now. But obviously, given how aggressively people think the Fed's going to cut, that's probably where the kind of divergence is.
So this is this is one of the charts that you actually shared with us. Looking at things, for example, you have your own forecast, but one of the charts that you highlighted was the NFIB small business pricing plans and the fact that that has now turned higher. So I'm sharing this chart. Hopefully people can see this. I'm having a few problems with my monitors. It's probably something tied to my sickness or the fact that I'm now down in the South. Harley's in California. I'm actually in Fairhope, Alabama, which is an unusual destination for me. I'm loving it down here. It's fantastic. All of you down in the South, you definitely have figured out a higher quality of life and a more enjoyable framework than those who are trapped in the Northeast. Part of the point that I would make on this is that we actually have a really interesting challenge because in order to develop relationships that tell us meaningful clues on inflation, we actually have to have some inflation variability. And so the chart on the right, I'm actually breaking that down and looking at the dynamics of the NFIB price plans versus inflation. And one of the things that jumps out is I can't actually construct whether this is a leading indicator or a lagging indicator. And I'd be interested in your reaction to that, right? It feels very much to me that small businesses are both reacting to changes in inflation, and we're seeing almost equal explanatory power with moderate leads. What's your thinking there?
So the way we kind of search for lead indicators is slightly different. So our emphasis is kind of purely on correlating turning points rather than kind of the overall explanatory power, right? So, if you think about the economy, trying to forecast a level is basically like an impossible task because clearly as things are dynamic, it's endogenous, the coefficient is going to change all the time. But when you think about the sequencing in the economy, turning points have a pretty reliable kind of sequence in terms of this happens first, right? It just sometimes there's a longer lag or shorter lag. So there's lots of these kind of relationships where if we can find the turning point correlation and then use that to screen for inputs, we can create models that are a bit more sensitive to the turns. And that's kind of what we're using. So, I mean, if you want to get all geeky, we do like Fisher transforms on the data and then, try and correlate those. But basically the idea is that do you have a reasonable thing where if you see a turning point, suddenly you care? The rest of the time when it's trending, then obviously the standard models do a pretty good job, right? You only really care when it's going to have a turn.
So just very quickly, a Fisher transform is effectively just looking at a z-score of deviation from a trend. Is that a correct interpretation of the simplified way to think about it?
Yeah, well, you can imagine. So like, for example, you got the chart up here with like the core CPI, right? And obviously after 21, the black line goes through the roof. Once you transform the data, you basically just compress it onto the same scale. So effectively now the mid 2000 kind of hump at the top is the same magnitude as like the late 2000s, and then you basically compress it down. So basically now when you run statistics or things, you're not affected by the distortions, right? Like all the turning points are kind of look the same, and there's like a magnitude thing breaking it. That's kind of a little bit what it does.
So it effectively is reducing the outlier impact. It's not quite Windsorization, but it's transforming the data to achieve something similar to Windsorization. Okay.
Yeah, kind of, yeah.
Got it. So one of the things that you have highlighted in materials that you shared with us is one that feels very topical, which is this underlying idea of, what is liquidity and what does it actually mean? And so if I think about the themes that you kind of shared with us, in preparation for this call, I just want to run through kind of the key points, and then I want to jump into some of the individual components of it. First, as you looked at the US, you were highlighting that the consumer is still spending, that labor hoarding, effectively companies being unwilling to let workers go, despite the fact that we've seen demand deteriorate, particularly in areas like manufacturing, construction, et cetera, that's given consumers a false sense of job security that's allowed them to continue to spend. And yet, interestingly enough, their personal finances are very clearly deteriorating. You suspect that once profit margin pressures start to bite, the labor cracks will go from gradual to a sudden deterioration. Can you expand on that a little bit?
Yeah, so the easiest way that you can visualize labor hoarding is to look at surveys of hiring intentions versus earnings. So the kind of most egregious one we show is within the NFIB survey, where the actual realized earnings have been pretty poor, right, and trending down since COVID, but hiring intentions have remained very elevated. And what's very interesting is, these time series go back decades, right? And historically, clearly they're correlated, because almost by definition, as a business, if you're not making money, why do you want to hire people? And what happened after COVID was that relationship broke. So even though earnings came off, hiring intentions have stayed elevated, much higher than where earnings have gone. And, it kind of makes sense, right? And there's lots of explanations, whether it's like the demographic shifts in terms of the labor market, or like work from home, or like, everyone has all this excess savings, people don't want to do the jobs, various reasons or another. You've had a situation where, businesses have struggled to find labor, and there's lots of things on surveys on quality of labor and so forth. So clearly they're going to be a lot more reluctant than a normal business cycle to lay off workers, right? It's going to be like the last cost they cut, and they're going to have to like let other costs go first. Now, obviously this varies by sector, because clearly if you're a tech company and everybody's been studying computer science, for the last 20 years, there's an abundance of software engineers, you're not worried about laying people off, right? You can get them back. You don't have to overpay. If you're like industrial company, you like an energy company, like how many like geothermal scientists, whatever, geology scientists have been graduating, right? So there's been this, in a way, like a capital cycle almost within the labor market in terms of which areas are being hot, and it's affecting kind of this ability for companies to hire the kind of right workers. And so that's why I think is contributing to this kind of seeming kind of contradiction, right? Where on the one hand, leading indicators are bad. On the one hand, companies are concerned about, the outlook, yet the labor market has clearly been, very resilient. And you only ever see these kind of layoffs coming in the kind of, we would say capital abundant sectors, right? The sectors that they're not worried about labor. And so I think that's kind of the explanation. And how long does this last? Well, it lasts until you run out of kind of the kind of spare margin these businesses have, right? If things truly deteriorate enough, you're going to have to be forced into layoffs. And so I think that's where the kind of idea of gradual and sudden, right? To quote the Hemingway bankruptcy kind of thing, it should be a very exaggerated impact, where as a business, you're probably holding off until the absolute last moment. You're really going to have to be forced into it.
So that's actually a really interesting point, though, that you bring up, which is the difference in the construction, or the difference in the supply of labor in areas that have experienced tremendous growth, whether that's software engineering or computer science, that have not yet seen the huge productivity improvements. I mean, it's interesting as we think about things like the implications of Chat GPT, et cetera, on potential productivity or automation tools in programming, productivity occurring in the software engineering space, which really hasn't hit previously, versus what you're highlighting. Like there's still significant shortages of oil field drill workers, et cetera, construction workers, plumber, particularly in the skilled trades, things like plumbers, et cetera. Those are very hard to replace. And so what you're highlighting is that those are the areas where we're actually seeing the labor hoarding. We're not necessarily seeing it at Microsoft or others who are well supplied in their labor, whether that's domestically or through things like H-1B visas type dynamic. That's actually a really interesting point. It's one I'd not heard emphasized before. Do you see one of the charts that I would highlight is this underlying issue of small business? I agree with you that it is very interesting, right? I'll use the proverbial loaded phrase that small businesses continue to emphasize that they can't find workers, even as I look at things like their small business sales, and their sales expectations look incredibly recessionary, right? I mean, this is about as ugly as it gets. This is data sets, to your point, going back into the 1970s. We've just never seen anything like this outside of, the global financial crisis. Now the question is, and this is something we were talking about beforehand, like we've been in this cycle for so long that unless an additional catalyst emerges, this is one of your second points, do we actually see a restocking and a recovery period, even if the economy is not quote unquote strong?
Yeah, and by the way, if you look at the NFIB components on labor and also on loan availability, those are the ones that go all the way back to 70s.
Yep.
They give you a phenomenal lead on kind of NEPA corporate profits, like just phenomenal, and like working over decades and decades. And obviously, the intuition is that they're clearly non-discretionary expenses, right? Generally, your labor and your financing costs are very significant and usually non-discretionary. So there is a persistent kind of headwind there. And obviously, as kind of the lagged effects of interest rates follow through, that headwind's clearly going to be there. Like, one of the big things, it got really hot on Twitter last year was, these charts of like net interest payments are going down, even Fed's hiking. And like, you just have to look at the chart, just push it forward, right? That's like a 2-year.
Yep.
So like, there's a lot of these relationships that suggest the headwinds are coming on costs. So it's really now contingent on extra stimulus to force revenues and demand up. Otherwise, profits are going to get hurt, right? And so this comes back ultimately to kind of the 2023 discussion, right? Fiscal, right? It's like the most obvious answer, run 7% GDP, great. But now you're going to have to maintain it. And then what's kind of the extra on top of that if costs are truly going to pick up? And that's, I think, the kind of crux of what's going to happen here, right? Like where's that extra stimulus going to come from if the government cannot maintain the same pace of fiscal stimulus? So I think that's why ultimately in the US, it feels like the risk is somewhat to the downside in terms of obviously we're pricing a soft landing, right? And then clearly the economic data has been pretty good. So yeah, that's kind of, if I was to take it through, that's probably where it shakes out.
Okay, I apologize. I'm having some troubles with my screen, so it makes it more difficult for me to share some of these slides. I'm going to try one more time, then I may hand it over to Brian to drive here if I continue to have challenges. So this is really hitting on the second component of your arguments, right? That the EPS estimates are defying negative guidance, job openings, and higher rates. We're seeing the pressures building on the cost side. The question really becomes, do we get that additional stimulus? And kind of even though it caught some headlines today, like the idea that we're going to have $100 billion tax cut, strikes me as, in the greater scheme of running a $2 trillion deficit as we've run in the past year, as a very modest incremental fiscal stimulus. Do you see it differently? Do you see continued fiscal pulse? And this almost overlaps then with the MMT type framework, where my good friend, and I emphasize good friend, somebody I respect a lot, Warren Mosler, is highlighting dynamics that, as long as the US is running these types of monetary type of fiscal deficits, that getting a recession becomes very hard. Do you have a different perspective on that, or do you share his underlying perspective?
I think getting a kind of, like GFC, like you want like a big daddy recession, then yeah, I think it's gonna be hard. But if you want to get some, earnings down, right? Like some, like a kind of a reset, then it obviously depends on how the rest of the economy reacts, right? Like the whole difficulty and I guess the fun of analyzing the macroeconomy is it's not a static thing. It's not like I can hold everything else the same and I just pump up fiscal and then clearly everything works, right? Just even historically in recessions, you can run big fiscal deficits, right? And it hasn't mattered. So it's really about how the kind of different pieces fit together. And so I think on the fiscal side, the impulse is actually marginally negative. The key for this year is more about will the Fed do the preemptive cuts, even if we don't get kind of the bad data, right? Because the only comparable scenario to today now is 1967 in terms of a soft landing. And the reason I say that is the divergence between leading indicators and coincident indicators in the US is obviously absolutely epic, right? And this is like obviously a historic lead lag. And so the closest analogy we can find is 67, where basically the Fed went big, cut rates a bunch, ultimately facilitated a kind of more inflationary end to the 60s in terms of 69, 70, but they staved off a recession, right? That 67 was the only situation where leading indicators looked really, really bad.
So let's jump to a couple of slides that hit on that. So
how do you
go
mention
ahead, Harley.
how do you mention MMT with a straight face? Haven't we shot this thing down yet? They print money to get inflation, and then we're going to solve it by the government cutting spending. Like, that's a laugh. That's not going to happen. This whole thing was
again, Harley, this is one of these challenges, and we really have to get Warren on with you at some point. The challenge on MMT is it is descriptive of the way the world works, right? It is an accurate representation of a fiat-based model. What you're correctly highlighting, and by the way, I agree with you, is it still matters how you spend the money, right? So if I choose to spend a whole bunch of money adding to the productive capacity of my country, I'm going to have very different long-term results than if I spend a lot of money buying lottery tickets for my citizens. That's just a different outlook. So when you talk about MMT framework, this question of are they increasing the quantity of income that is flowing to the private sector that is being handed from the aggregate social purse, you can't really argue with that. I'm not sure what your pushback is.
This whole thing is rainbows and unicorns. Okay.
Keep on going. To believe in both. They're both beautiful. All right. So you, Tian, you approached 2023, I think, from a very thoughtful perspective. One of the things that you were highlighting is that, we can explain 2023 largely on the basis of positioning, that people had gotten super, super bearish. And the liquidity component more than anything else is just people reversing elements of that. We didn't quite get down, it's interesting if you look at the risk on positioning from somebody like a State Street Investor Confidence Index, we treated 2022, December 2022 looked an awful lot like late 2008, the immediate aftermath of COVID, et cetera. Is there something else that you would highlight? You've mentioned this idea of liquidity, and a lot of people have talked about this framework of liquidity. So let's take the positioning for a given. What does liquidity mean to you, and how are you thinking about it?
So obviously as we were discussing before we started recording, right, it's kind of the Supreme Court definition of pornography, right? It feels like it means something different to everybody. So the work we did was on trying to reconcile like all the different ideas, right? Because no one's stupid in here, right? And people have logical arguments. The question was, is there some first principles ways to tie it together, right? There's on the one hand, how do you tie together bank reserves, RRP, TGA, right? That mechanical impact. What about M2, right? What about credit spreads? What about the curve? What about real yields? And so it turns out, I think one of the best concepts to think about it is from Perry Merling of, Zoltan's mentor fame now, but his work is unreal. It's so good, where he talks about this idea of the hierarchy of money. So you can imagine like a pyramid where at the top is kind of the bank reserves of the high power money, and you have deposits, right? And then the deposits are further, and then further below deposits in the pyramid is like loans, and then below that securities, right? So the high power money, the tops, enables the layers further down. And so we're obviously as investors mostly in the securities layer. and we're impacted by all the things above it. And so this is a really nice framework because it can be used when central banks intervene, when they don't. It can explain historically why things like credit spreads, all these things mattered. But the key thing to know is we're living a different monetary policy regime these days, right? After the GFC, the Fed obviously does a bunch of things, right? Run an excess reserve regime. They pay interest on reserves, right? They intervene in all sorts of asset markets, right? Traditionally, we have this concept of central banks as lenders of last resort, right? SVB happens, the banks, use reserves to support deposits, and that's it. But these days, obviously, what is QE, right? We'll go in and intervene directly in the securities layer. So there's lots of different changes that's impacting this kind of traditional hierarchy of money. And so when we think about it like that, you can actually measure the ratio between this high power money to kind of the lower quality money, right? And I think that's like the key thing we want to measure. The way Perry Merlin talks about intuitively is like, in the good times, everything's worth par, right? Your Bitcoin, your meme stock, you think it's going to be worth $1, maybe it's even more, and you think it's the same as $1 in the bank. And then SVB happens, you realize your $1 SVB might be 95 cents, let alone whatever else you own. So this thing only matters obviously when bad things happen. So by measuring the ratio between these things, it's almost like a margin of safety measure in the same way PE ratios are. And that's almost the exact analogy where your equity earnings are what's available to support the market cap, right? That's basically the way to think about it. So when we think about liquidity, we should think about how much high power money is there to support deposits, how much deposits are there to support like credit, and how much credit is there to support kind of, broader securities. And so that's kind of the analogy to PE. And so a lot of, including ourselves, right, one of the kind of errors of omission we made historically was to think about liquidity as a rate of change concept too much, right? Did interest rates go up? Did these rates of change go down? But in a way, that's very similar to the idea of, like a PE ratio is 5 times and it goes up to 10 times. Sure, it double, but 10 times PE is still probably a reasonable level, right? That you have a reasonable margin of safety. And I think that was a little bit of the realization in that we needed like the equivalent level measure for liquidity and not just use all the kind of rate of change stuff. And so obviously it's quite hard to take these all into one number, but the bottom left-hand chart is basically a representation of it, where ultimately I just Z-scored it to make it fit on the line. Where essentially, if the red line is really high, it's telling you this is a great time. There's tons of margin of safety in the kind of liquidity money market stack. And then when this line is super low, it's telling you there's a lack of margin of safety across the entire hierarchy of money. So
and I would just highlight that there are components of that are not just the quantity dynamics, but also effectively the animal spirits component. You referred to this. I always remember back in the late 1990s, I would speak to people who had, pre-IPO investments and stuff, and they would literally talk about it as if, well, that's $10 million, right? And it was, no liquidity to it, no actual underlying cash component or value. It was just an expectation of how much something would be worth in the future. And crazily enough, people believed deeply enough that they were spending that. I think you alluded to Bitcoin or some other components as well. There might be elements of that in play today, but you're not actually incorporating that variable multiplier as you're thinking about this type. This is much more just the ratio that you're utilizing here. Is that correct?
Yeah, so we're actually trying to get a measure of the level of all market cap of kind of securities, right? And the level of all loans. So it's kind of the ratio between the levels. So obviously, ultimately, it's a proxy, but if you want to build a simple version, the Fed flow of funds obviously has fantastic data. It's just a bit slow every quarter, right? So you can actually build this out using that data as well. And the key takeaway was that, again, obviously with the benefit of hindsight, not surprising, but just given the sheer magnitude of stimulus in the system, and given obviously in 22, the entire market cap securities really went down. You had a lot of kind of, high power money at the top supporting like a lower kind of market cap at the bottom, right? And then all it took was the Fed and, BTFP after SVB to say stuff. And then slowly but surely, this ratio needs to normalize. So the main takeaway is that from a level point of view, in terms of the margin of safety embedded in the entire kind of monetary system, we're only at neutral right now in terms of levels, but the rate of change is negative, right? So that's a little bit how I would conceptualize liquidity's impact right now.
So if I'm looking at a chart like here on the top right, which is the business cycle financing index, leading risk assets, I don't see the same dynamic that I'm seeing in the bottom right-hand side where the Merling multiplier effectively popped. So if I'm distinguishing between these two, you would effectively say the liquidity is going to be the most important component. The business cycle component is going to be a secondary indicator, in part because unless things get so bad in the business cycle, I'm not necessarily going to have to challenge my belief structure, right? A good, really simple example would be a company goes bankrupt. If the economy goes through a Lehman type moment, they can't access their cash. Because we didn't experience anything like that, even as the business cycle indicator looks to be as weak as it was in 2008, it doesn't have the same impact. Is that a reasonable interpretation of those two charts?
Yeah, I would say so. I would just think of, obviously, BCFI, we call it BCFI, but just think of it as like, did interest rates go up or down, right? So it's effectively saying interest rates went up a lot, so the overall business cycle financing conditions getting worse, right? That's kind of what it's saying. Whereas the bottom one is effectively like, what's the PE ratio or the bottom left is what is the PE ratio, but used in the liquidity context. And the bottom right is what's the change in the PE ratio.
But again, just to orient people to this. So if I'm thinking about the Merling multiplier, that would be the equivalent of saying, what's the ratio of credit outstanding to M2?
It's an average of all the ratios. So what's the ratio of reserves outstanding to deposits outstanding? What's the ratio of deposits outstanding to loans outstanding? And what's the ratio of loans outstanding to securities outstanding?
Got it. Okay. And so is there a particular weight that's being put onto a base layer versus the next layer, or is it just a true average?
I've just simple averaged it because obviously it's just to give you the concept. Yeah.
Got it. Okay. All right. That's super, super helpful. Because the chart above is, I think, very similar to the types of charts that I'm seeing over and over and over again. This idea of the alligator jaws that have effectively opened up between what we would think of as traditional indicators, something like a business cycle. Your point is it's on interest rates. Again, there's some modification that's occurring here, but ultimately, what you're saying is that the traditional signs of tightness have gone up. I would incorporate things like the SLUs. I would incorporate things like the ISM, et cetera. And that's telling me that like credit conditions should be really, really tight. The credit spread should be really wide, very much like what you're seeing in this top chart. But you're highlighting that the existence of an adequate supply of liquidity has forestalled that day of reckoning, at least for now.
Yeah. And obviously so it's just a potential. It's like how big can the potential move be, right? If you short 100 PE stock, you obviously got more upside than shorting a 5 PE stock. So that would be the kind of idea.
Can I jump in here for a second?
Yeah, please.
I'm
struggling with that last one. I want to think about
it. Is it possible that R star has just gone up by a lot?
That's the next slide. That's exactly where that's exactly what I wanted to do, was go to this slide, which is looking at variant versus Williams. What changed? So your dashed line is effectively the same as saying R star.
Yes, yeah. And all we've done is just try to only fit the model to pre-COVID conditions, and then just let the kind of really volatile COVID data play out in 2021, 22, and then just let it obviously behave naturally now. Right. So obviously, those spikes down is because the data got all messed up, right? From COVID, you had to, all the annualized things changed. But now it's kind of suggesting, this is obviously real neutral rate, call it 175, right, plus or minus. So depending on where you think inflation is going to be, let's say 2.5, right, reasonable, anywhere to 2.5, so nominal, probably like 4. That's probably a fair, neutral nominal rate if the Fed achieves their inflation target.
I mean, we keep talking about how we're restrictive and the Fed's taken rates up by 500 basis points in a year and a half. And the economies, we have unemployment under 4. We have, whatever inflation is, but the economy is growing at, 2.5 and change. What if our star's 4 and change now? I don't see where any evidence of there being restrictive on the economy. I mean, I guess you have some underlying numbers that you point to, Mike, but on the top line, it ain't happening.
Well, I mean, the obvious point that I would highlight, I mean, one, what Tian has done here is they've fit to the data as compared to articulate a statement as to what the underlying R star should be, correct?
Yeah, this is just based on the current coincident data. Yeah.
The second component is that when I ultimately think about something like R star, it has to be a function of the quantity increase in labor in our term, in unit terms that's available to me, and the number of the amount of productivity that I can expect from each of those units of labor. So when I look at a world like we had in 1900, in which Americans are working 6 days a week, 16 hours a day, basically getting no sleep in many productive situations, the only way for the hours to grow is for the quantity of people to grow. And in fact, as living standards rose, the hours shrunk. I think one of the interesting questions for me right now is this issue of how do we actually see that expanding? How do we see that changing? It's very clear, I think, that people have been able to add some productive hours by cutting out commuting, but it's not at all clear to me that the capacity for significant productivity enhancements are there unless we start changing the composition of our economy pretty significantly. Chen, do you have a different view in terms of what the potential looks like?
I think I probably more broadly agree with you, Mike. And four real R star seems pretty aggressive. That probably means like ChatGPT really needs to take off, and we're going to get a bunch of real growth.
Yeah, that's kind of my take, and I would I would also emphasize the economic possibilities for our grandchildren aspect of it, which most of the indications I'm seeing are that people would actually prefer to work fewer hours, even as they're getting paid more, and effectively have less share going to the owners of capital. It strikes me as one of the key risks that we need to consider going forward, as the societal framework has apparently changed somewhat.
But how come one of your inputs is not just the flood of money, of paper money the Fed printed, and the massive?
Because that wouldn't be a real concept, right?
We've massively altered the amount of money in the market relative to GDP and population, haven't we?
But that would show up. I mean, that's the whole point that you've made, right? That would be a one-off shift in the price level.
Maybe having this larger pool of money, it just means you have to go and hit the brakes harder to go and stop the car.
So that's saying velocity of money picks up, right? And
I mean, we keep looking, as Mike says, alligator jaws of things happening. I mean, maybe one of the jaws is pointing the wrong way because we're using an old paradigm.
I think that's actually, I mean, while I disagree with it, I actually do think it's an important consideration, right? What are the paths?
Go back to that Bloomberg slide you had there.
The Bloomberg slide. This one you're talking about?
Yeah. Why do you think for like 20 years, it's a relatively stable number, and then all of a sudden, since the Fed started printing money or getting more involved, it's become very volatile?
I don't think that's what it is at all. I think this is, I would highlight that this is the emergence of China as most favored nation status, which distinctly benefited large business over small business.
Okay. I mean, something's clearly changed, right?
It might. This is the interesting question, right? I mean, this is the dichotomy that seems to have emerged. I would highlight that small businesses are experiencing exceptionally high interest rates. We see this in the financing numbers. Chen was highlighting the cost of financing that we can get from the NFIB numbers, or the average rate that they're paying. Those numbers are now, I believe, about 9.8% is the number we're getting from the NFIB. That's dramatically higher than the rate that Apple is paying, for example. The advantages just continue to accumulate for the larger companies, and that certainly, I think, actually plays through to the higher profit margins that we're seeing for corporations. We're just not seeing that in small business. I mean, I'm sure somewhere in our audience there's a distinctive overrepresentation of small business individuals, I assure you, if I could physically and I weren't sick, I would give you a hug because it feels very ugly out there for small business. Ken, do you see it differently, or?
I don't have that strong view on. Yeah, obviously I agree with the small business, small large, right? And we see that in the price action, right? We see that in the quality of balance sheets. Yeah, so that I agree with, but yeah, I think this whether there's been it's a fundamental regime shift. We wrote a big white paper on, we called it Age of Scarcity, right? And the core idea was that, we've experienced decades of kind of cheap credit, cheap labor, cheap commodities. And if all three start to reverse at the same time, like on a kind of look forward basis, then clearly, that kind of necessitates a completely different kind of asset allocation shift. So I still think structurally that's probably where we're going, but obviously that's like a much more 5-year plus kind of view. But for us, those view, what's driving those views is a lot of our kind of capital cycle work, right? Where we've noticed kind of just the years of underinvestment in certain sectors and just kind of overcommitment of money and kind of people and money into certain other sectors, right? So I think that's more the outcome. If you want to talk about what's really going to shift, it feels more like clearly politics has shifted. So ultimately, fiscal monetary policy going to be a bit more coordinated. We're clearly in an environment where fiscal is going to be more political as well. So the credit allocation mechanism is going to be worse. So a lot of these things are kind of more likely to be structurally inflationary, right? The people who are going to get credit is, hey, if you're green, you have any kind of eco angle to it, you can benefit, you'll get all the tax deductions. Whereas if you have some business that isn't in that bucket, clearly you're disadvantaged. So I think those are probably like the more obvious shifts we see in explaining what's changing. That credit is just much, much more kind of, the allocation of credit is much more politically driven.
Respecting that we're an investment show, we have to feed the beast. Looking at all your charts and graphs over here, where would you point investors? Not specific stocks or names, but just in general. Are you favorable to equities, to bonds, to commodities, to oil? Like, what is the medium term, projection of where you think we should be, overweighting our portfolios?
Yeah. Well, obviously, Harley, the reason we connected was we want our, we've been pitching long tips and long MBS, and in particular, specifically, what you guys have put out, right, in terms of, making sure you get the
no tickers, just to be clear.
Yeah. So I think long tips, long MBS in terms of fixed income bucket, within equities, long energy, long EMs. So I think broadly speaking, it's more the fact that today is very interesting because there's a big divergence in what asset prices have discounted in terms of hard and soft landing, right? So yeah, you can be like, I'm bullish bonds or I'm bearish bonds or equities. But the point is, under the hood, there's like a massive divergence, right, within each asset class. So yeah, if you look at equities, then large cap US clearly has a lot of good news priced in, but there's a lot of sectors that don't. So if you're long defensives, long staples, right, utility healthcare, you probably have a lot more upside than just generically saying going long S&P, right? So for us, I think we still want to be a bit more defensively positioned within the kind of main portfolio exposure. So overweight tips, MBS, and that's your kind of main fixed income bucket. Within equities, it's more tilt towards, again, defensive sectors, but also tagging on some things like EM, energy, right? That's been beaten up. Oil is very interesting because being long oil, if you have a risk off, might sound like you're doubling up, but clearly oil's come off a lot. We're rebuilding the strategic petroleum reserve in the US. A lot of bad news being discounted in there. And there's obviously a lot of worries about geopolitics or whatever, right? So like it's quite nice that it's got a lot of bad news priced in. There's a lot of different risk off that might make it go up. So yeah, broadly, I would say, underweight equities, overweight bonds, but within equities, there's obviously pockets of value, just like within bonds, probably still time to stay away from nominals and focus on kind of where you can pick up good valuation, right? And that's obviously in the spreads and in real yields.
And we're looking at all your charts. I mean, and the ones Mike has also, you have these nice, beautiful little relationships that go on for decades. And all of a sudden we have the alligator jaws happening everywhere on everything that we can't explain. Can I draw a lesson from that something's happened that we don't understand, and maybe the whole concept of value investing is out the window, that the whole Benjamin Graham, that's useless now, that there's other things that drive investments? I mean, Mike would say it's indexing that's driving it as opposed to value. Do you have a thought on that? I mean, is there a value to actually looking under the hood at a discounted cash flow, or is it something else that is more important?
Sorry. Yeah, look, I hear you. I think one of the one of the concepts coming in is clearly where are the relationships that are still working and where isn't, right? And clearly going and prioritizing that's important. So one of the interesting things about 23 was lead indicators did kind of work for Europe, right? For China, right? China reopening was a dull lead indicator, saw that. Europe disinflation, but also Europe recession, they saw that. So it's really specifically within US consumer, US labor market, that's kind of the epicenter of things that broke, right? We still had industrial production was down, manufacturing was obviously hit, obviously housing's gone through its own cycle. So that's why I think going back to kind of, maybe it's a good way to circle back to that kind of the beginning of the conversation. In my mind, the whole focus is labor hoardings impact and the US consumer, right? And the fact that it's tied into it. And the fact that in our view, yeah, maybe it's labor hoarding, maybe it's the drawdown access savings, maybe it's the fiscal. But what's really, really interesting is that when you look at consumer real consumption, out of COVID, you had to step up in the level of real durable goods consumption, right? And since then, it just got grown at trend basically from this higher level without any give back. In most normal business cycle, inventory cycles, there's a bullwhip inventory cycle effect where once you kind of overconsume, it kind of feeds through the supply chain. And then there's like you draw down inventories, they rebuild inventories, and there's a short. What's really interesting, that's like a very persistent divergence. And I think that's where the opportunities are going to be because there's actually gaps opening up, right? You have companies that over-earn for 2-3 years out of COVID, suddenly disappointing, and the stocks gets hammered. Whereas you have others that's still going up and it's going fine. So I wouldn't say it's broken in that it's just a blanket, it's broken, right? Lots of pockets of this framework still work. The key is to understand why kind of certain segments haven't. And obviously because it's the US, it's very high profile. But, we've hit on some of that in terms of fiscal, labor hoarding, and so forth. Yeah, so that's probably the way I would think about it. It's a very valid question to be like, is lead indicator just wrong?
It makes me wonder, Mike has data going back to caveman times. Somehow he makes them up. And it's making me think that maybe we're looking at the entirely wrong window of time. I mean, people look at the World War II, or they look at the 20s. I mean, is it possible that really what we should be looking at is like the 1880 to 1910 of the Gilded Age, when we had monopolies running the world? I mean, right now, the Mag 7 basically are legal monopolies that have infinite pricing power. I mean, maybe that's what's going on here, is that we don't have competition anymore. I mean, is that possible?
Yeah, I think certainly, obviously, going back to even right at the beginning of the conversation, Jonathan wrote the book, in terms of oligopolies, pricing power, and so forth. So clearly that dynamic is in place, but obviously, history just rhymes, right? It doesn't repeat fully. And I would say the biggest shifts is that, people's understanding of how the world works improves over time and data is more available over time. So it's, if we can all see that same data, it probably won't play out exactly the same. And if anything, the way I would think about it is maybe it's so hard going back to why it didn't work is positioning and these things matter, right? People are a lot more aware of what's going on. So in addition to trying to understand what will happen, it's even more important than ever to learn how to play the game of investing, right? Understanding how other people position, where the divergences are, and then actually trying to take advantage of that. That's probably more how I would think about it, because these questions are obviously very hard to answer. I can't give you a good answer, but I suspect, the policy regimes are very different, right? Central banks, lenders of last resort, all the things we talked about are different. And that's probably more what's driving it than, like the, wild days of, Rockefeller, and, you can get away with anything.
Well, I actually would extend kind of what Harley was saying, and Robert Hall has actually written a recent paper on this. Others have highlighted this idea that is dismissively referred to as many who are ardently pro-capitalist without fully understanding the complexities around that dynamic. And just to be clear, I'm about as capitalist as somebody can get. But the point that he would raise is that when you experience a major shock like COVID, it actually becomes much easier for companies that are in oligopoly or in a monopoly to raise prices under the rubric of, well, everyone, prices are going higher, right? We have to raise so that we can get our part. And people oddly stop in comparison shopping. They basically decide that they can't really worry that much about it. We were in some ways trained for this by things like toilet paper shortages during COVID, where we basically said, just buy it if it's available. Now there's evidence that seems to be breaking down. We're seeing particularly the consumer packaged goods, the staples providers are suggesting that there's increasing price sensitivity that's reemerging. Tian, are you seeing any evidence of that in your work, or is there anything else that's going on?
Yeah, because this is the whole greedflation, right? I think it is
Yep.
Professor Isabella Weber's kind of main thing. So we actually thought that was a really cool idea and essentially basically tried to do the very similar methodology. So it's possible to quantify how much of inflation is being driven by labor versus corporate profits. And for sure, out of COVID, you had kind of basically 2 years of inflation pulling up corporate profits. That's basically ended. Right, so it's no longer pushing up corporate profits, but it's not necessarily a detractor. So I think that would broadly fit. Like you can actually quantify this, yeah.
And so are you finding that that's actually the underlying case, that there was more of a push from the capital side than from others, or what's your...
Yeah, so definitely out of COVID for like the first 2 years, corporations managed to boost profits from inflation, which historically is obviously quite rare. And so to your point, they more than raised the prices to compensate for how much their costs were going up.
That's the so-called greedflation.
Yes, yeah. But if you measure quarter on quarter, it's kind of diminished already.
Right. And this is, I think it is actually important. I think it's an overly dismissed component for many in the industry, right? This idea that corporations suddenly got greedy. No, that's not the case. It's just their capacity to actually exploit that was improved by the volatility that we experienced.
Yeah, right? Temporary monopolies across the board, right? Once the supply chain shuts down, everybody has a monopoly.
Correct. So once the minute you move into that, you start. The other component is that if you actually have pricing power, you immediately move to a lower level of production that can create persistence in inflation. We definitely are seeing components of that. I see Jeff and his gingerness has showed up, and we are that tends to be the clue that we are being given the classic sheep's hook, shepherd's hook. Jeff, is that indeed the case?
Yeah, sorry to play time police, gentlemen, but
that's okay. We understand. Okay, fantastic. All right. Well, listen, Tian, this was really excellent. We have 3 presentations from you. Is it possible for us to include links to those, include those on our website so that we can distribute those to the people who attended?
Yeah, absolutely. Yeah.
Fantastic. And if people want to follow you, they can find you on Twitter at Variant Perception, VRNT Perception. Is that correct?
Yeah, I mean, we're probably not as prolific as you. But obviously,
that's okay. Very few people are either as prolific or as handsome as me. But so if we want to find you on Twitter, we can go there. And then Variant Perception is also your website that allows people to consider access. It is an institutional product. It is premium priced, and so we're really pleased that you've allowed us to introduce you to some of our audience. And hopefully, people found this as interesting as we did. Great start to 2024, guys. Harley, I got to tell you, I'm on the back foot again on the inflation front. You're smacking me around. This is not an interesting start. Jeff, I'll let you wrap it up.
Thanks, Mike, and thank you, Harley and Tian, for an informative and interesting conversation today. For the audience, please remember to register for our next Keeping It Simple. It's going to be on February 8th. The title is Goliath versus Goliath. Mike and Harley are going to be joined by Matt Stoller, who's the Director of Research at American Economic Liberties Project. They'll be discussing the growing issue of monopoly power and the role of the state. So it's sure to be another spirited and fascinating conversation. So I hope you'll all join us. And with that, I hope everyone has a great afternoon, and we'll see you next time.